In this video, we are going to talk about property and motor vehicle insurance. Let's start with defining insurance. What is insurance? It's just a risk management approach. Insurance is protection against possible financial loss. It gives you peace of mind. Insurance is something you have that if there's a negative event or an event that impacts you negatively and it requires financial support or it involves some kind of financial loss, then insurance comes in and covers it. An insurance company or insurer is a risk-sharing firm that assumes financial responsibility for losses from an insured risk. So really, you get a bunch of people together, and since bad things don't happen to everybody at the same time, and if it does, it's a big problem, then they're pretty much taking money from a group of people, and when needed, diverting it to the one that needs it, and then it gets recovered through premiums, etc., over time. And of course, then they keep a profit, keeps a little bit of that money for managing that. People purchase a policy, the firm assumes the risk for a fee called the premium, which the insured policyholder pays periodically. So as you see, the firm assumes the risk. So insurance, it's a way to see it as a way to see insurance is a transfer of risk. Types of risk. Risk is just uncertainty at the end of the day, uncertainty of XYZ of blank or lack of predictability. Well, if you can't predict it, it's uncertain, such as the loss that a person or property covered by insurance faces. So peril is the cause of a possible loss, such as fire, windstorms, explosions, robbery, accidents, and premature death. Of course, that's not all the list. Anything that can cause loss is a peril. Hazard increases the likelihood of a loss, such as a defective house wiring. So just like it says, increase hazard, increase the probability of a loss, increase risk. Pure risk. The most common risks are classified as personal risks, property risks, and liability. Insurable risk, chance of loss, not gain, and accidental and unintentional risks. Nature and financial costs of the loss can be predicted. Now, I'm going to take a moment because we already went through, risk, types of risk, insurance is transfer risk, and like that. At the end of the day, when we look at insurance, it is something that you may want, but hope you never need to use it. So I think it's one of those few things, probably the only thing that is that you pursue it, you pay for it, but you actually hope you never have to actually use it, because then something bad has to happen for you to use it. Speculative risk, chance of either loss or gain, such as starting a small business or gambling. Uninsurable risk. Now, the big difference, I guess, chance of loss, not gain. Speculative, just like sounds like you go to the casino, for example, and some stock trading. Risk management methods. Risk management is an organized strategy for protecting assets and people. Risk management techniques, risk avoidance. You can never completely eliminate risk. All you can do is use tools and strategies to avoid it as much as you can in order to minimize risk. But risk can never be completely eliminated, not as we know it. Something bad can always happen, even by chance. Risk reduction. it's kind of the same. The more you reduce risk, the more you're avoiding it. So things you do is wear seatbelt, install smoke alarms, eat a balanced diet, exercise, things like that. So seatbelt, clearly car accident risk, smoke alarms, fire risk, eat a balanced diet and exercise, your health risks. Risk assumption, self-insurance. If you don't have insurance on something, you're assuming your own risk, you're self-insuring. If something bad happens, you pay for it or just take the loss. Risk shifting, and that's what we mentioned earlier. You're just moving the risk from you to the insurance company. Transfer risk to insurance company. That's what you're paying for. A deductible is the set amount that the policyholder must pay per loss on an insurance policy. Most of y'all are familiar with this, but let's say you have a deductible of $500 on your car. So you get an accident, the first $500, you pay for it. And then they cover the part above $500. Potential property losses. So on property, we talk about houses, cars, furniture, clothing, property, just what it sounds like. Risk is really physical damage caused by hazards such as fire, wind, water, and smoke, destruction of property, or temporary loss of use. Now, these could apply to a car, but also to a house. On the car, then you also have the, your accidents, car accidents that happen. Collision. That'll be physical damage as well. Risk, loss of use. So another type of risk is you can't use anymore due to robbery, burglary, vandalism, or arson. So one thing is a physical damage that can be replaced or repaired, and loss of use is pretty much gone. So let's talk about the different types of protection. You have liability protection, which is legal responsibility for financial costs of another person's losses or injuries. So this is not when, well, it depends from what angle you're looking at it, but let's use the car example. By law, you got to have at least liability insurance. So if you cause damage to somebody else, then the insurance can pay that somebody else for their losses. Negligence, failure to take ordinary and reasonable care, such as failure to supervise children in a pool. Let's use a different example. This is your typical situation of if you get injured in a public place, in a mall, in a hotel, at a restaurant, and it was demonstrated that it's because the establishment was negligent on their safety standards. So they fail to take the ordinary or reasonable care. And then they'll have insurance to cover that. Strict liability. A person is held responsible for intentional or unintentional actions. Oh, let me go back to negligence. People at your home, if they get injured, you could be responsible under the negligence piece. Strict liability. A person is held responsible for intentional or unintentional actions. Just what it sounds like, intentional or unintentional. It's just that when it's intentional, brings in a whole different laundry list of issues. Vicarious liability, when a person is held responsible for the actions of another person. I guess you are responsible for your children. That'll be one example. If your children do something, you have that liability if they damage some property. Parent held responsible for child causing physical harm to another. Employer held responsible for an employee causing damage. This is fairly common. Let's say somebody goes to your home to do some work, electrician, plumber, anything, and they cause damage to property or person. So the company becomes responsible for their employees. This is part one of this video. We're going to go ahead and end this piece here. We'll continue with the rest on the next video.